Good morning, all. Welcome to today's Phillip Securities Research Morning Call. Today, we have several stock counter updates. For results, we have Bank of America, Tesla, Netflix, Google, Keppel DC REIT. For updates, we have OCBC, Suntec REIT, OUE REIT, and Frasers Centrepoint Trust. For Phillip On The Ground, we have TSMC, Hutchison Port Trust. And we'll also have our usual SG Weekly REIT 31 for macro and sector outlook, as well as SG Air Transport Monthly. Kindly note that Zane is on leave today, so there will not be any technical analysis today. We may have to wait until next week when he's back, or if you have any questions, you may also post in the P3 community chat. This is a disclaimer slide that any information presented is solely for educational purposes and should not be considered as financial advice. Without further ado, I'll hand over the time now to Grant. Thanks.
Hey, thanks, Iqbal. Yeah, just to note that Paul is also not around today. I think he has a meeting to attend. I will also be leaving right after I present my part because I will be attending the IFAS briefing as well. So Zane, Paul, and myself will not be around to answer the Q&A. Yeah, so if you have anything for us, just put it in the P3 app and we'll try to get back to you. Yeah, so without further ado, I'll just start my part first. We'll be starting with Bank of America. Yeah, so Bank of America, they released their second quarter results. Earnings did rise by 3% year on year, and they were in line with our estimates, with the first half earnings around 50% of our forecast. So for the positives, the first positive is that their lower cost has continued to benefit the net interest income. So what I mean by lower cost is that their cost of funds or their interest-bearing liabilities rate, the decline more than offset the decline in the earnings asset yield. So that's how they managed to get this rise in their net interest income. We expect that this trend will continue with and this is mainly driven by lower deposit costs, their fixed rate asset repricing, as well as loans growth, which will help to cushion the net interest income. The second positive is that their investment and brokerage fees have continued to support earnings. Asset management fees were up 9%, and it benefited mainly from the strong AUM flows as well as higher market levels. And global markets revenue also rose by 10%. So global markets consists of the FICC as well as equities revenue, which both rose from the heightened market volatility. So as a result, overall, the investment and brokerage segment rose by 11% year on year and was also the main contributor to earnings growth. For negative, the first negative is that their provisions have risen, mainly from a net reserve build. So net charge-offs were quite flat year on year, but this net reserve build of 67 million compared to the previous year's net reserve release of 25 million resulted in the provisions rising by 6% year on year. For the investment banking fees were also a bit of a drag. Their global banking revenue as a whole fell by 6% year on year. I think the main difference was that the investment banking fees did fall, mainly led by a decline in the M&A as well as leverage finance fees. Bank of America still did manage to maintain their number 3 position in the investment banking fees. For the outlook, they have maintained their guidance for net interest income, guiding it to grow by 6 to 7% in FY25. And the growth is expected to be more significant in the second half as compared to the first half. So growth drivers again will come from the fixed rate asset repricing and also loans growth and an improvement in the global markets net interest income. Expenses are also expected to grow more slowly with a guidance of 2 to 3% year on year increase. So this has also been maintained. For their, we believe that they still have quite a sound asset quality. So despite their net charge-offs, dipping slightly for the quarter, it's actually it's quite flat, to be honest. Their provisions did rise from this net reserve build, but if you compare it to their peers like JP Morgan and Wells Fargo, they reported lower provisions, mainly from lower net reserve build as well as lower net charge-offs. So Bank of America's net charge-offs didn't increase, but they did a net reserve build as compared to a net reserve release the previous year. For the tariffs, Bank of America they have started to see improving market conditions during the quarter, and they continuously expect no recession and also a modestly growing economy at around 1.5% and no rate cuts until 2026. So we do downgrade to accumulate with a higher target price of $50, mainly due to the recent share price performance. And we have raised our FY25 estimates by 2% from higher net interest income estimates. So we expect growth drivers for Bank of America to come from higher net interest income, continued growth in the wealth management fees due to higher capital markets activity, higher global markets revenue from the heightened volatility, and also a slower pace of expense growth. So now moving on to the next counter that I have is Tesla. Next slide. Yeah, so for Tesla, their second quarter results were above our expectations. The first half revenue was at 45%, but adjusted PATMI came in at 78% of our forecast. And this is mainly due to higher than expected gross margins. So we expected gross margins to further compress in the second quarter, but I think it improved slightly. But if you look at it on a year-on-year basis, it has still fallen. So overall, for the second quarter, Tesla's results were again yet another disastrous quarter, right? Everything fell except for their services revenue, which is the first positive and I guess the only positive that I have, which is that their services revenue rose by 17%, mainly due to increased volume as they have added another 2,900 net new supercharging stations, and they managed to grow the network by 18%. But then again, non-auto revenue, which includes services revenue as well as energy storage, was put down slightly by a decline in the energy generation and storage revenue. I think because they haven't fully ramped up the mega factory Shanghai yet, so they have only started to deploy mega packs from this mega factory. We do expect that the energy storage revenue will continue to rise in the second half of the year, mainly as the ramp up from this mega factory Shanghai will begin. So resultantly, if you look at the total non-auto revenue, it was up slightly by 4%. As for negatives, there are quite a few, but I think the first one and the biggest one is that their deliveries have declined again, and they have set a new record year-on-year decline. So it fell by 13.5% in the second quarter, and this is following the 13% in first quarter 25 as well as in fourth quarter 24. So this decline came from model transition disruptions, a weaker demand in major regions like the US, Europe, and China, the brand headwinds tied to Elon Musk's political controversies, as well as Chinese EV makers' competition. As for the margins, it has also declined again, mainly due to lower vehicle average selling prices, as well as higher operating expenses from their AI and R&D projects, and the decline in vehicle deliveries, and also the lower regulatory credit revenue. And this is actually the third lowest gross margin that has been recorded since second quarter 2019. We have also estimated that their ASP, or average selling prices, have declined for the 10th consecutive quarter, with their second quarter ASPs down by 2% year-on-year. For the outlook, they have shifted to a less optimistic commentary. So they have warned that the evolving trade policies are injecting uncertainty into the automotive as well as energy markets by disrupting global supply chains and cost structures for Tesla. And also, meanwhile, the shifting political sentiment, especially in the US, could materially affect their future product demand as changes in the support by the government, such as subsidies, tax credits, emissions rules, and infrastructure funding, may become less favorable for Tesla. They finally did provide some guidance for 2025, but did not give any specific figures in terms of like revenue numbers or delivery numbers. But they said that they will continue to invest in growth for both its vehicle and energy business, and they also their focus in the near term is to grow their vehicle volumes efficiently by maximizing their current production capacity. And also, in their pipeline, they're looking at their more affordable model. I think this is the main thing that they're using to compete with the Chinese EV makers, and that it's ready to launch. It's still on track to launch in the first half of the year, but I mean that's already passed, so I think we'll be looking to see it in the second half of this year. And also that their Cybercab, the robotaxi, is also scheduled for volume production in 2026. And over time, I think more in the medium term, they expect profits to increasingly come from AI, software, as well as fleet-based services alongside hardware. So we maintain a sell with a slightly higher target price of $220. I guess we are quite cautious still on Tesla, mainly due to the removal of the EV tax credit, lowering emission standards, as well as Chinese tariffs, which could lower demand and margins, ongoing competition from the Chinese EV makers, particularly BYD in China market. Also softness in the overall EV demand outside of China, particularly in the US and EU, and also the significant revenue contribution from their multi-year initiatives like their full self-driving, robotaxi, or even their Optimus robot, right? It's still several years out. We're estimating around 3 to 5 years out. And also steep valuations of around 180 times PE suggest that this really has been priced ahead of time. So that's all I have for Tesla. I'll now go on to my last uh, counter, which is OCBC. This is really just a quick update on the GE Great Eastern, delisting and I guess the whole saga of what's happening. A quick recap in case you're a bit lost also because it's been over a year that this has been ongoing. So in May last year, they did the first offer of $25.60, and then in July last year, trading was suspended for GE shares because they got quite a number of shares, but not enough to officially delist, but enough so that trading has to be suspended. But they did fail to delist because less than 75% of the minority shareholders accepted the first offer. Then in June again, they did the second offer at $30.15. And in July, it failed again because only 63% of minority shareholders voted in favor of the delisting. Again, 75% was needed to go ahead with the delisting. So what they did was, in order to, because they got pressured by SGX to restore the free float, right? Because if not, it'll be still in limbo, is that they announced this 1-for-1 bonus share issue to restore the minimum free float. And how they do it is quite a creative manner. To put it very simply, is that they did this 1-for-1 bonus share issue for all shareholders of GE, including themselves. But there are two options that you can choose as a shareholder. The default one being that it'll be an ordinary share, so it will have all the everything normal. It's just a typical share, so you get voting rights, you get dividends, everything. But there's another option where the second one would be the Class C non-voting shares, and so this is what OCBC will be opting for, and that's what you'll be getting, this Class C non-voting shares. And what this will do is that it will not dilute their ownership of GE, but it will dilute their voting rights. So effectively, if they take this on and the rest of the minority shareholders take on the normal ordinary shares, it will be able to dilute them to their voting rights will be below 90%, right? So the free float will be restored above 10%. So that is an ideal situation. I'll now be moving on to the next slide, where we're looking at 3 different scenarios of what can happen moving ahead, since they announced this already. The first one is that GE resumes trading. Ideally, OCBC takes up the Class C, only OCBC takes up this Class C non-voting shares. So OCBC has already committed and saying that they will only be taking up this Class C non-voting shares. So they have around 93% of stake in GE. So all of their shares, of their new bonus shares, will be these non-voting shares. Yep, so public float will go down, will go above 10%, and then GE shares will resume trading. The second one is that it will also resume trading, but there will be some minority shareholders who take up this Class C non-voting shares, right? So less than 35%. If less than 35% take this up, then the free float will still be above 10%, and then they will still resume trading. So there's for shareholders of the minority shareholders of GE, what it is that default option, if you don't do anything, is that you will get an ordinary share. But if you choose and you opt in to take the Class C non-voting shares, then you can opt in for that. But it's an opt-in option, not you have to choose either one. So the last one, and I think the one that will be, I guess, the least likely, but also a possibility, is that more than 35% of the minority shareholders take up these Class C non-voting shares. So what happens is that more than 35% or less than 65% of minority shareholders take up the ordinary shares. OCBC ownership will not change, but the public vote purposes as well as the voting rights purposes, OCBC stake will still remain above 90%. So this is the most worrying one, because trading of GE shares will remain suspended, and all the minority shareholders will still get their dividends, but they will not be able to trade their shares in the open market because it will still be suspended. This is a possibility because there's one group of minority shareholders that I guess they were the ones that held out right during the second exit offer, and then they might purposely go and change their shares again. They might be thinking that this will be the thing that will force OCBC's hand to give a better offer price, or a third one. third offer. But I guess OCBC has come out to say that they will not be doing any more of this already, so that's highly unlikely. What does this mean for OCBC shareholders? The ideal situation for OCBC shareholders is that GE will resume trading, right? Because this is taking up a lot of the time, effort, and as well as money from OCBC to try to settle this, I guess this whole saga. Yeah, so that's the most ideal situation. So I hope I managed to explain it quite simply, and everyone can understand this whole GE saga. Yeah. So that's all for me now. I think I will hand it over to Helena. Yeah, thanks.
Thanks, Glenn. I'll be talking about Netflix. So Netflix released their second quarter earning. Just looking at the set of numbers, it's pretty decent. The second quarter revenue and PAMI meet our estimate. If you take a look at the first half, our revenue and PAMI, they were at 48 and 54% of our FY25 forecast. So revenue growth was 17% year on year. It's driven by higher subscription revenue. So jumping straight to the positive, the first one is they still have very solid content, so that is driving their subscriber growth. So Netflix, starting from last quarter, they no longer report their subscription numbers, but management has said that their user engagement remains very strong. So the reason for that is in the previous quarter, they have a very compelling content lineup. They have Squid Game, Sirens, Ginny and Georgia. Then for the remaining half of the year, they still have more hits like Alice in Borderland, Troll 2, and Stranger Things coming up. They're having a very affordable pricing right now. The cheapest plan starts at $7.9 per month. So that continues to attract a lot of the budget conscious consumers amid a very challenging macroeconomic. So revenue growth accelerated to 16% year on year, up from the 13% in the first quarter. This is slightly exceeding their 15% year on year guidance. I guess the most important part is they're slowly changing in their narrative. They're changing from volume to value now. Just follow them stopping to announce their subscription number. So they have started to raise price for their plan in several key markets in the end of last year. And simultaneously, they introduce more affordable, like ad-supported plans. So if you want to opt for a cheaper plan and you don't mind watching the advertisement, they have that. So that dual approach, it kind of supports their ARPU growth without impacting their subscriber retention. So their users continue to perceive very substantial value and are willing to adjust their plans in order to the response to price hikes. So if the price went up, you feel like it's not very worth it, you can offer the cheaper ad-supported plan. And concurrently, they are putting a greater emphasis in their advertisement as a key driver for their profitability. It's still in very early stages, but the company has set a goal to roughly double their ad revenue in 2025. So this entire strategic shift towards more value than volume monetization. So overall, it contributed to around 6.8% expansion in their operating margin. Last but not least, they have pretty positive guidance. Moving on to the next quarter, they've guided 17% year-on-year growth for the next quarter. Still a very strong content slate lining up. And for FY25 overall revenue, previously they guided 12 to 14% year-on-year. Now they increase it to 15 to 16% year-on-year. But that is mainly driven by the depreciation of the US dollar, not really for any changes in their plan. So I also expect a 1.8% year-on-year improvement in their operating margin for the next quarter. But one negative point that we realize is their engagement per viewer likely has declined because their engagement increased only 1% year on year. But if we take a look at their membership ad, even though they no longer announce it, but just look at their revenue, which grew 14% year on year for the first half, it's probably going to be much bigger than 1%. So that kind of signals that the engagement per viewer has declined. And lower engagement is going to be tricky for them because that means fewer ad impression per user, and that can potentially reduce their advertising revenue. However, we think part of this can be caused by them recently trying to clamp down on account sharing. So previously, there's a lot of people piggybacking on each other to use the same account. So now they're trying to clamp that up. So a lot of the casual and infrequent viewers, they're forced to open their own separate account. So those accounts, for sure, it's going to have lower engagement because they don't really watch, right? So overall, that kind of lowers the engagement per user. But at least for now, the company is still guiding they're gonna double the ad revenue. So we're been monitoring the matrix from onwards. So overall, we see Netflix, they still remain very resilient because they have very limited tariff exposure and they have very strong earnings. They maintain its leadership in the streaming industry, and they also have very notable pricing power in improving margins. Their content stay is paying off and will continue to pay off. But just look at the valuation right now, it appears very stretched. It's trading at 37x forward PE ratio, which is well above the industry average, which is less than half. It's only 17x. So our valuation remains unchanged. Our DCF target price is still $950. We have no change in our forecast. It's just because the recent price rally was too much. Because of that, we downgrade our recommendation from neutral to sell because the fundamental doesn't really change. So we don't see that how it can climb up to that high. Yeah, so overall we downgraded from neutral to sell recommendation. So that's all from me. I'll pass my time to Serena.
Thank you, Helena. Good morning, everyone. I will be presenting our second quarter 2025 results. So overall, the revenue and PATMI were actually within our expectation. The consolidated revenue up 14% year-on-year to 96.4 billion because of strong revenue growth across all the core business segment. First, for the positive, search performance actually slow, but continue to be resilient and 12% year-on-year. This is mainly driven by retail and financial services. YouTube ads also increased 13% year-on-year. This is led by the direct response, followed by brand, especially in shorts. So we continue to see the short monetization continue to improve because of their seamlessly feed ad format for better user experience, so the user will not actually feel as intrusive, and actually the rise in the user engagement. Currently in the US, the platform actually now earns as much revenue per watch hour as per YouTube, and even surpass in-stream rate in other countries. So moving forward, we do actually believe the business segment ads will continue to show resilient growth because of their better ad targeting capability and stronger user engagement. And then secondly, for cloud, it remains the faster growing segment, growing at 32% year-on-year despite a supply constraint. The growth was mainly driven by a larger GCP client base, which grew actually 28% quarter-over-quarter. And because Google actually managed to sign more deals. So in the second quarter, the company actually doubled the number of deals, over 250 million, and they already achieved the same number of deals over $1 billion they did in financial year 2024. So moving forward, the company actually expects the tight supply condition will keep going into financial year 2026. They currently do have a cloud backlog of $106 billion. Overall, we do actually believe Google cloud business will continue to show better results when more capacity coming online. So this is why we leave the estimated revenue growth unchanged at 35% year-on-year because of a strong cloud demand, Google capability to acquire new clients, and also the better operating margin. Third, for the positive, the cloud margin actually continued to expand to 20.7% from 11%. This is driven by the strong revenue performance, which actually allowed to offset the higher depreciation. But overall operating margin and Google service margin actually flat at 32.4% and 40.1% respectively. Alphabet actually mentioned that they will continue to focus on cost efficiency to offset the rising expenses while they ramping up the AI-related investment. As for the negative, the CapEx spending in the second quarter actually increased almost 70% year-on-year to 22.4 billion. The company also raised their expected CapEx for the entire year by $10 billion to $85 billion. This is to actually support the strong cloud demand. The higher CapEx actually we do expect have a short-term impact on the valuation because of the higher depreciation expenses, which is currently growing at 35% year-on-year. But on the longer term basis, we do believe that it could be offset by the strong revenue growth from all the core business segment and their effort on cost optimization. In terms of outlook, the company actually provides some guidance on the potential moderation of revenue growth in the third quarter because of two reasons. The first one is the FX headwind under a stronger US dollar, and the second one is the by comparison a strong US election spending in the second half of 2024, especially in shorts. So moving forward, for financial year 2025, we actually do things that the revenue growth actually to be supported by three reasons. The first one is the 35% year-on-year cloud growth due to the continuing strong demand with a bigger client base and the increasing number of sizable deal. And the second one is the continued monetization improvement of Shorts and YouTube subscription growth. A little bit of an insight, we actually do believe that YouTube is playing a significant role in contributing Google's revenue. This is supported by the company's double-tier strategy to boost their platform monetization, which is a combination of ads and subscription. So CTV continue to boost the ad revenue from the retail vertical, and YouTube Shorts is actually showing a quite strong momentum in second quarter with the double click-through rate. Is an indicator of how many people actually click on the advertisement after viewing it, and actually 80% higher after brand lift. It actually suggests a better user engagement, and the subscription business also reported a strong revenue growth of 20% year-on-year. This is driven by the increasing paid subscription from YouTube and Google One. And the third reason is the solid ad revenue driven by AI development with better ad target capability and user engagement. We actually do believe that Google's Gen AI chatbot, which is Gemini, and the traditional search engine, they are still showing some resilience despite the competition from ChatGPT. The user engagement continue to grow. Currently, the daily requests are up 50% from the first quarter, and Gemini monthly process token is actually has also doubled since May. It actually could suggest the user actually asking for a longer and more complex question, and the Gemini actually has a higher capability to actually process it. In addition, the AI overview actually drives over 10% more queries globally. This is actually readings that it reflects a strong user interest in the AI enhanced search experience. So overall, we do actually see a stickiness in the user behavior and remain quite positive because of Google has a really massive user base. And the higher engagement, we actually think that it could also lead to a better quality data to actually enhance the ad targeting capabilities. For Alibaba, we actually maintain a buy recommendation with a reduced target buys from $250 to $235. This is due to a short-term pressure on the valuation under a higher capex, but we do increase the revenue forecast by 3.5% because of the resilient ad and subscription business, and also expect to improve cloud service delivery. We do expect the company will continue to benefit from the AI-driven product enhancement and operational efficiency. This will actually boost cloud capacity and also strengthen their ad targeting capability. And regarding to the share price, it still remains attractive in our opinion because it's currently trading at a discount with a PE ratio of 20.5x, which is below the 5 years historical average of 25x. That's all for me for Alpha, but I'll pass the time to Iqbal. Thanks very much.
Thanks, Serena. Yep, I'll present Phillip On The Ground on TSMC. They released their results about 1 week back. Now, so for those who are unfamiliar, TSMC is a manufacturer of advanced chips. So they define advanced chips as those 7 nm and below. So this makes up 74% of their 2Q25 revenue. Yeah, sorry about that. Yeah, so for their 2Q25 revenue, it increased 35% year-on-year. It beat their guidance, and this is being driven by strong demand for their 3 nm and 5 nm chips. As you can see in the chart below, the 5 nm represents the green color segment, whereas the 3 nm represents the red color segment. So as you can see, for the past few quarters, those two has been ramping up because of strong demand. And the guidance for the next quarter, 3Q25 by TSMC is that it will increase 38% year-on-year. And this is very positive because their guidance of 38% is actually higher than their actual performance for 2Q25 itself of 35%. As for their margins wise, management did mention that they expect an average 3% gross margin dilution, which also means it will decrease by about 3% every year for the next 5 years on average, because due to increased costs from overseas fabs itself. For example, their Arizona fab will need higher costs in order to manufacture the chips itself. For TSMC wise, there's mainly 3 growth drivers. Firstly, there's a growth in token volume because of increased AI model usage and adoption. They did mention in their previous quarter that the rise of DeepSeek has enabled a lot more enterprises to come into the AI scene and run AI models. So there's increased demand in advanced AI chips. Second growth driver for TSMC would be that they expect volume production for the 2nm chip in the second half of this year itself, and they expect the RAM profile to be similar to the 3nm chips. So the RAM profile will be similar to what you can see in the red color segment in the chart below. So that is the RAM of the 3nm chips, and they do expect similar RAM profile for the 2nm chips itself. For the third growth driver for TSMC, it will be rising demand from sovereign AI. So this means governments from different countries. Firstly, they mentioned they will invest 165 million in advanced semiconductor manufacturing in the US because there is strong demand, as we all know from Trump, to bring manufacturing of advanced chip into US soil itself. Yeah. Secondly, they will also be building a technology fab in Germany. And with the support from Taiwan government, they also built wafer manufacturing fabs in Taiwan itself. Our outlook in general is that the increased capex investments by TSMC, for example, the $165 million dollars in capex for advanced semicon manufacturing, right? It should benefit equipment makers, for example, Lam Research, ASML, and Applied Material, because we do estimate that about 70% of these capex will go into equipment makers' revenue. And TSMC has also mentioned that the continuation of the H20 chip sales to China should be able to benefit both NVIDIA and TSMC. However, this is not being included in their forecast yet. Yeah, so we do see an additional upside in terms of their forecast, because currently their forecast is such that they exclude the China segment entirely from their forecast. But however, with the change in policy that allows H20 chips to be sold to China itself, this may provide an additional upside to both NVIDIA and TSMC. Yep, that's all from my end. I'll hand over the time now to Miao. Thanks.
Yeah, thanks, Evan. Next slide, please. Yeah, so in July, aviation sector delivered a very strong performance, with CAO leading the performance, surging by 15% month on month, on the expectation of strong first half result. Yeah, next slide, please. In June 25, travel demand stayed robust, driven by the start of the summer travel season and Singapore's mid-year school holiday. So this resulted in a 4.5% year-on-year increase in SIA passenger traffic, surpassing 3.1% year-on-year growth in passenger capacity. And next slide, please. And for the cargo front, it continued to shine and remain resilient, underpinned by the front-loading activity during the global trade uncertainties. However, the momentum has been slowing down, so load factor rose by only 0.4% year-on-year, which is lagging behind the 3.3% increase in capacity. Yeah, next slide, please. And something positive is US travel demand continued to recover, supported by Trump's tax and spending policy. So in June, domestic air travel rose by 3.7% month on month and 2.6% year-on-year, with international passenger volume saw substantial 9.9% month on month increment. And Delta Airline actually reported a pickup in corporate travelers. And note that consumer appears to be more resilient to trade tension. And also second half forward booking looks strong at the moment. And therefore for outlook, we do expect some spillover effect for Asian carriers. Yeah, next slide, please. And for SIA, we expect first quarter 26 earnings to be supported by lower jet fuel price, as IATA projected crude oil to be an average of 69 per barrel, US dollar per barrel, which represents 13% year-on-year decline. However, we still expect like near-term tailwind for its yield, given that Asia Pacific carriers are still expanding capacity rapidly. And for sets, we anticipate resilient top line for first quarter 26, supported by front-loading activities. And they'll also be benefited from the rerouting activities from China. However, global air cargo growth is projected to be slowing down in 2025, especially with the removal of de minimis exemption and also declining ocean freight rates, which makes air cargo less appealing. And for China aviation oil, international air traffic surged by 31% year to date in May 25. So we do expect Shanghai Pudong International Airport, which is their associates, profit from associates to increase by 12% year-on-year in FY25. And overall, we have a neutral recommendation for the aviation sector. Yeah, next slide, please. And Suntec released the first half results last week. Yeah, so which is in line with our expectation. And its DPU, first half DPU rose by 3.7% year-on-year to 3.15 cents, underpinned by a 6 million saving in finance cost. And something positive about Suntec is they achieved strong rental reversion of 10% for its Singapore office portfolio and 17% for its retail portfolio. Occupancy costs in Suntec City rose marginally by 1 percentage point to 23%, and Suntec remained confident of achieving rental reversion of 10 to 15% for its retail asset in FY25. Supported by healthy footfall driven by F&B and also bar segment. So management continue to observe signs of downtrading with fast food tenants outperforming and also like fashion tenants underperforming. So they are very likely to replace the fashion retailers with higher margin principal operators. And their Suntec convention segment continue to shine with NPI rose by 64% year-on-year, and also operating margin expanding by around 9.6 percentage point year-on-year due to increasing higher yielding events and also lower utility cost. And Suntec do expect second half performance to be on par with first half, with further margin improvements due to higher yielding events. And yeah, so they're also introducing some new functions like the engagement center to optimize costs for the operator, since they do observe like some of the events are shifting to like lower cost countries like Bangkok or India. And we expect upside to come from finance cost. Saving in finance costs, since like finance costs decreased by 7.9% year-on-year in first half 25. And for negatives, overseas performance continue to be the drag, and incentives in Australia are creeping up, especially for Sydney and Melbourne office region. And for UK, we do expect backfilling of minister building. So occupancy rate will increase a bit from next quarter onwards. And for outlook, divestment of strata units in Suntec office has been slower than expected, with only 1 unit sold year to date, as majority of the buyers are owner-occupiers. And Suntec office has a very high occupancy rate of 99%. Yeah, so that's why they do expect demand to remain muted in second half. Yeah, but something positive is we anticipate some tax saving around like 1 to 2 million tax saving from the UK portfolio. Since Suntec is qualified under the UK rate regime, which will lower the effective tax rate from 25% to 15%. Yeah, so we maintain buy recommendation with higher DDM back target price of $1.36. And Suntec is trading at FY25 dividend yield of 5.3% with 0.6 times price to NAV. Yeah, next slide, please. So OUE released the first half 25 result last week. And results are in line with our forecast. DPU rose by 5.4% year-on-year to 0. Yeah, so something positive is the strong performance from commercial segment. OUE achieved strong rental reversion of 9.1% for office and 34.3% for its retail segment. And this was driving so the high rental reversion for its retail portfolio was mainly due to the low base signed during COVID period. And so they do expect rental reversion to stay at high single digit in FY25, supported by a below historical average new supply in CBD area. And we expect mid-single digit rental reversion for office asset, supported by sustained flight to quality phenomenon. Since like near-term supply pressure is already eased, with like 85% of the IOI tower already occupied. And DPU upside is expected to come from saving in finance expense. And our cost of borrowing is likely to stay flattish. Is expected to trend lower to around 4% in FY25, as they are refinancing another 300 million of the loan ahead of its 2026 maturity, with margin at half of the original rate. Yeah, so we do expect cost of borrowing to decline to around 4% from 4.2% this quarter. And for negatives, hospitality segment remain weak for OUE REIT, with RevPAR declining by 13% year-on-year in first half 25. And Hilton declined by more than 20% year-on-year due to cautious travel sentiment, lackluster event schedule, and also increasing supply in Orchard area. So Lady Gaga concert actually didn't contribute much for RevPAR for Hilton. Yeah, and they do anticipate less contribution from American and also Chinese guests, given the highlighted geopolitical pressure from the US. And also Golden Week will be overlapping with F1 in October this year. So there will be less demand from Chinese travelers. And yeah, we do maintain buy recommendation for OUE REIT with unchanged GMTP of $0.4. They are currently trading at FY25 DPU of 6.4% and price to NAV of 0.5 times. Yeah, that's all for me. I'll hand over to Darren for KDC. Yeah, thank you.
Yeah, thanks, Miao. Yeah, before I begin, just a note that Zane, Paul, and Glenn are not in for Q&A today. So I see some people still typing in TA questions. So Zane will not be able to answer those. So if those are burning questions, please feel free to type in the P3 or next week. Zane will be back to answer those. Yep. Yeah. So for Keppel DC REIT, they released their first half results. So they had some exceptionally strong positive rent reversion. So the gross revenue was up 31%. That's because of the contribution from SCP 7 and 8, the acquisition of those, and Tokyo Data Center 1 also. And it's slightly offset by some one-off the DXC settlement sum that was received last year, as well as the divestment of IntelliCenter Campus and the Castle Park Data Center. Yeah, their finance costs, they also saw some savings there, similar to OUE and Suntec. Yeah, so 5% savings for finance costs, and their distributable income or DI basically is up 57% also because of that. But their DPU is lower because of that large share base, but it's still up 12.8% year on year. And the Guangdong data center is still they're not receiving any contribution from that. So the impact to DPU was 0.492 cents for the first half. Yeah, and for the positives for KDC specifically, in the first half they saw some positive rent reversion of 51% in the first half of 2025. So if you remember the first quarter of 2025, the reversions was 7%. There was during that quarter there were no major renewals. So the major renewal was the SGP4 that was in the second quarter. So that rental reversion based on our estimates came in above 55%. So that's extremely high. And that is for Singapore co-location a major renewal. Yeah, but other than that, the portfolio occupancy dipped slightly to 95.8%. First quarter is 96.5%. Yeah, and for Keppel DC REIT, their foreign source income is now hedged till 2026, to end of 2026. So that is a lesser risk from the FX perspective there. And their gearing right now is at 30%. So this gives them some headroom to acquire some properties. They're looking at some third-party acquisitions in countries such as Japan, South Korea, and Europe, where the data center hubs are more established. Yeah, but the gearing is expected to increase to 35% to finance the land lease extension for SGP 7 and 8 that will be used, that will be drawn down to pay in the second half of this year. Yeah, and like for the negatives, the rental still continues to accrue at the Guangdong data center. So there is no clear timeline for resolution for that. It's been over a year, almost 2 years now. And right now, about 40 million is owed in overdue rent from Blue Sea. So that continues to be a headwind. Yeah, but the Singapore portfolio for Keppel DC still remains exceptionally strong, especially the co-location renewals. We've seen so many quarters of renewals of 40-50% rental reversions for the Singapore co-location assets, the major renewals. Yeah, for the outlook, generally the DC demand continues to remain very robust. So things like AI adoption, growth in cloud computing, digitalization, all these helps to boost the demand. And like I mentioned also, Keppel DC REIT, they are looking for third-party acquisitions. So not only from their sponsor in countries such as Japan, South Korea, Europe. They're looking at, for Japan, perhaps a cap rate of around 4% works, and South Korea, Europe, maybe around a 5-6% level. And they announced that they will be divesting BC's data centers in Malaysia, so that will be expected to be completed by third quarter 2025. Yeah, but for our call specifically, previously it was an accumulate. Our previous report before this one, the share price of Keppel DC was only about $2 flat. Yeah, that's why we had a accumulate call with target price 225. But right now the price has really spiked or really risen to $2.32. So as a result, after we adjust some of our numbers, a call now is neutral. So it's kind of downgraded by a slightly higher target price of $2.33 because of the recent share price performance. And right now, Keppel DC REIT, they're paying a dividend yield of about 4.5%. Yeah, so that's for Keppel DC REIT. Next slide, please. Yeah, so for Frasers Centrepoint Trust, so it's a business update. So no financials were provided for this business update. But some operational highlights is that their portfolio occupancy now is at 99.9%, so it's basically full already. And the tenant sales and shopper traffic continues to improve. So you see tenant sales rose 4.4% year on year. Shopper traffic rose 2.1%. If you exclude the effects of the Tampines 1 AEI, all these were still up positive year on year. The cost of debt was also improved for FCT. So it improved 10 basis points quarter on quarter and improved 50 basis points year on year to 3.7. So for the full year, we're looking at about 3.8%. So the financial year is September. So is upcoming in the next quarter. And for FY26, we're expecting the debt cost of debt to drop to about 3.5%. Yeah, considering now that SORA has really fallen so drastically. Yeah, 76% of their debt remain on fixed rates. Yeah, so their gearing, it ticked up slightly, so it's 42.8%. That's after the acquisition of North Point City South Wing. But going forward, we expect it to decline to 40% when they use the proceeds from the 200 million perps that was issued at 3.98% to repay off some of the higher interest rate debt. Yeah, so the perps were issued at a lower rate. The originally was guided around 4.2%, but now the perps issued at 3.9%. So that's a plus as well. Yeah, so for the Hougang Mall AEI right now is 74% pre-committed, and they are targeting an ROI of about 7%. So this Hougang Mall AEI is slated to be completed by September 2026. And for the retail space, there is limited incoming new supply over the next 3 years. Yeah, roughly around 2% of current stock. So that is the whole retail supply. If you just calculate the suburban mall portion of that retail incoming stock is even lower than that 2%. It's like a third of that. And because of that, the potential for rental reversion still remains very high, especially since if you want to have some retail space in FCT's portfolio, basically the occupancy is really 99.9%. So the bargaining power is very high for the landlord or for FCT. Yeah. Occupancy cost of 16% is also below pre-COVID level. So that is also another positive where they can continue to drive higher rents. And tenant sales are expected to be supported by the various government support measures like CDC vouchers, climate vouchers, and such. Yeah, there are many government support measures this year for SG60 vouchers and such. Yeah, but I wouldn't call it a drag, but the thing that is affecting the portfolio now is the cinema operators like Cathay. So Cathay remains in arrears. They are paying very little, but they're paying monthly, but basically they still owe money, but they are paying a very small amount. It's negligible, but basically the total contribution to their GRI is less than 1%. So that is not basically is immaterial and negligible, but there are some upcoming blockbusters and current big hits in the cinema. So FCT is hoping that this will help to drive footfall to their malls. Yeah. So no change to our TP, maintain our accumulate, and FCT is now paying a 5.5% yield. Yeah, thanks. Next slide, please. Yeah, so Paul is not in. Yeah, I have to cover his slides. So for the macro last week, there are some numbers. Yeah, but we'll focus on the new launch sales, the URA stats. So for the URA stats, basically year to date, or rather in the second quarter, the property new launch sales was up 62%. So that's high. And first quarter was almost 200% up. So we count year to date, or rather in the first half is roughly 150%. So this increased spike in volume will definitely support PropNet's earnings. So we are expecting to see some strong numbers from PropNet. The secondary sales is down, but that's mainly because of a very high base in 2024. Like 2024, it grew by 24% for the sub sales. Yeah, in the first quarter was up 32.6%. Yeah, and some other numbers that are up like office, retail, industrial. Yeah, stats, but we see mainly the strength comes from the retail and industrial rents is still improving year on year. Office is slightly down. Yeah, next slide, please. Yeah, so for the tactical views, basically we've seen everything rally in Singapore, like from construction and property, and some of the small caps as well. But construction and property were the stellar performers. So in just this month alone, we see WeHer, PropNet, LHN, CDL all up more than 20%. So, but whether this growth is sustainable is very questionable, as after 17 years, basically the STI is just up 8.6% from the 2007 all-time highs. So basically, after so many years, then you see like 8% growth. So it's quite low compared to the US, definitely. And the next phase for this rally will likely be from the results. So if we see some positives from the results, the rally could sustain possibly, and as well as the 5 billion deployment from the EQDP. So that will definitely benefit the small cap stocks. So other potential drivers are like the REITs, like especially from the fact that the interest rates we've seen really come down. The 3-month SORA, we saw it in the first half results already. And it is unclear, like because of the EQDP, the small cap, the fund managers, they'll need to match the amount that the MAS will pay, but it's unclear how that will happen. Or at least they must try to hit that target. Yeah, so that will also boost the party funding for the Singapore market. Yeah, but now REITs, from Paul's slide, REIT is a 4-letter word. Yeah, so right now REITs is up 2.4%. It was up about 4.5% in the month of June. So it's up also, but year to date is still kind of lagging the market by a little bit. The market is up 7.5%. Yep, and there are some green shoots like the 50% drop in Singapore interest rates, like the 3-month SORA. We saw it upwards of about 3% last year. So now it's fallen to 1.8%. So that's a real drastic drop. And a lot of the REITs, the floating portion especially, already benefited from that. And there's also a very resilient rental reversions that we've seen. Yeah, like also from the Meow Meow's presentation and the earlier Keppel DC and FCT slides. Yeah, so DPU also managed to grow already from the past 2-3 years where we saw DPU keep declining year on year from high interest rates. Yeah, so from a tariff perspective, Asian tariffs are 19 to 36%. So if Singapore holds a 10% rate, it's relatively more attractive already and more competitive as compared to a lot of the multiple Asian countries. So that date to watch out is the 1st August, the implementation date. So that's an important one. And there are many events upcoming like HSBC, Microsoft Meta, and the FOMC meeting in a few days' time. And yeah, but definitely the date to watch is the US bills and the reciprocal tariff deadline. Yeah, and we have many upcoming corporate insights webinars also. It's all listed there. This week we have AA REIT, Keppel DC combined wheel. Yeah. Next slide, please. Yeah, so some of the charts here. Yeah, so on the left hand side, we see a new and secondary home sales. The new home sales is really increasing, like it's ticking up. So that's the blue line there. Yeah, and the total volume is also increased 40% year on year. So that will benefit Propnex. And on the right hand side, you see the inventory is at 2 years. The inventory of 2 years is lower than the average of 2.7 years in almost the lowest level in almost 4 years. So how we calculate this is the planned launches divided by the past 12 months sales. So now it's at 2 years. So that is looking attractive. Next slide, please. Yeah, so for the rents, we see retail rents is actually increasing. The office rents has kind of fell. So we see industrial rents also kind of it's still positive, but it's definitely slowed from the COVID-19 highs where there was peak logistics demand from the boom in e-commerce. So yeah, office rents are softer, industrial is really moderated and stabilized, but the potential going forward now we think is still that retail the rents will continue to improve. Yeah, and for the pipeline supply, so the rents, the improvement in retail rents, like I mentioned during the FCT presentation also, is really boosted by the fact that there is very limited incoming supply for retail. Like retail is up 0.9%, or rather retail, the incoming supply over the next 3 years is about 0.9% until 0.9 per annum until 2028. So that will help to boost it. And if you look at suburban malls, it's even lower. The office supply is also quite muted at 1.5%. Yeah, but for office, you see a real spike in office rents. So going forward, we also expect the rents to slow. Yeah, next slide, please. Yeah, so this is just on the Marina Bay Sands, Las Vegas Sands. So Paul, he tuned into the earnings call. Yeah, so what the takeaways were that there were a lot of high rollers and were moving from Genting to MBS. So MBS is basically taking a lot of the market share. So the MBS casino revenue in 2025 is up 51%. So that's extremely high, but whether that will benefit Genting is questionable because the casino revenue for MBS is increase in that doesn't really mean that Genting's casino revenue will also increase. It might possibly mean that they're just taking market share or the high rollers from Genting Singapore over to MBS. Yeah, so that's the chart on the left. You see the market share loss in May, but Genting's results. Yeah, but for the mass market revenue and the high rollers, we see it really increasing. You see second quarter is up so much. Yeah, so that's the blue line and the beige line also, or rather the beige the bar chart. So basically, they are capturing a lot of market share from Genting. And yeah, they have more high-end market also, the high rollers. Yeah, next slide, please. Yeah, so for Hutchison Port Holdings, this is the Phillip On The Ground. So Paul attended the briefings the September. So they're port operator in China and Hong Kong. So for their results, basically revenue is up 6%, but the growth was mainly driven by the growth in volumes. So you see a 13% growth in the Yantian volumes. And there is a margin expansion also due to the decline in Hong Kong transshipment from the new Gemini Alliance. Yeah, but for them, dividends, they maintain at 5 cents. The guidance is like 11.5 to 12.5 cents. So that's about 8 to 8.5% yield. But they are planning to reduce that debt. So that might lower the absolute DPU ultimately. And for tariffs, we noted that the volume is down from US, but the strong first quarter was due to front loading. So going forward, we expect the second half to be a little weak. Yeah, I'll talk a bit about that after that. And for the China volumes, is still holding up better expected due to shipments to Europe and e-commerce. Yeah, from the US tariff, there is basically we noted that China they're doing more, or rather they're having more plans to trade with the Europe, shipping to Europe and to e-commerce boom as well. So that is similar to what we've seen with MLT, where they're moving the volumes towards Europe. And yeah, from e-commerce space, South China is less impacted than North China. That's mainly because South China, they focus on the smaller e-commerce items. So that's shipped by Express Sea. So from 35 days to 22 days. And their customers are Temu, yeah. And Yantian, they focus more on e-commerce, so that will benefit the Hutchison Port. And yeah, for the outlook, there is a real concern because in the first quarter and the fourth quarter in 2024, there was a lot of front loading. So we're expecting in the second half the volume to slow, especially from basically from the front loading. And currently the performance is better than expected, but the second half onwards, the operating performance basically will just be mainly hit by all the front loading and might slow, but they're still expected to pay about an 8% yield, 11.5 cents. Yeah. So that's for Hutchison Port Holdings of Hutchison Port Trust. Yeah, next slide, please. Yeah, so just moving to this table here. So this table is basically all the small caps that have still yet to hit the target price. So a lot of them are like China exposure or commodities. Other than that, a lot of the other small cap coverage that we have already hit the target price. Yeah, so all this likely will get a boost from the EQDP and from fund managers starting to invest in all the stocks using the funds from that. Yeah, so I think that's all the slides I have. Yeah, we move on to Q&A. Yeah, just a reminder again, Zane, Paul, and Glenn are not in. So yeah, if you can type your questions in T3, or you can wait till next week to get your answers, your questions answered. Yeah, thanks.
Okay, I'll take the Netflix question real quick. Do we expect Netflix to face more headwind with more competition and could lose volume at the expense of value? I would say right now, it's not that they're giving up on volume. It's more that they're shifting their focus to value more. Because the reason they stop announcing their subscription number is they feel like subscription number alone does not really fully represent their how their company is doing anymore. But that doesn't mean their subscription is not doing well. They're still doing very well, and they're still heavily investing in their content. So the volume wise, there's no concern. It's just they're shifting more to the value side. Will they face more competition? They will, because right now Disney, Amazon, and Max, they're all investing very heavily in exclusive franchises. So viewers, they might increasingly spread subscriptions across platform or churn more frequently. So that is definitely a possibility. And for rivals like Amazon and Apple, they have a lot of like bundled offerings. So that kind of makes Netflix a little bit hard to compete with them. And also they're trying to enter the ad-supported wall. And the ad-supported market, Hulu, Peacock, and Disney, they have already have their established advertiser. So that's going to make it a little bit hard for them to compete. But with that being said, we still think they're still sort of considered the leading monopoly in streaming, because they're still able to deliver very high value. It's a combination of high quality content and affordable pricing. They have 35% more membership than their second closest competitor, which is Disney, and their monetization was 2 times better. So we do think they're still leading it pretty strongly, especially you see how they continue increasing their price and all, but their subscription did not take a hit at all. So that means their leadership position is still justified. They still have very strong pricing power. So I hope that answers your question. I'll pass my time to my other colleagues.
Hi, I'll take the Alphabet questions. The question is, will Alphabet face more headwind on their search engine with more competition from adoption of AI search? Are they late to the party? I think in terms of the metric, maybe the headwinds lies on the market share. They might be reducing. I mean, moving forward, in my opinion, it might be a little bit hard for them to maintain over 90% market share like they did before. But I actually do believe that the performance still really depends on the fundamentals, which is how efficient is the monetization. Like I mentioned it during my presentation, we still see there's some stickiness in the user behavior, and I actually do believe that this is one of the Alphabet edge, because they do have a massive user base, and will be and they will be utilizing it. And secondly, because of the AI investment, they actually be able to effectively process more complex queries, and they can actually monetize it with it, because the data they receive will actually provide more insight, so they can then do a more precision in ad targeting. This will actually helps to boost their advertising business, because the competition of the ads will actually makes the pricing competitive. I hope this answer your question. I'll pass the time to my other colleague. Thanks very much.
Thanks, Serena. Take on some questions. Yeah, I see there's some TA questions, but Zane is not here, so I'll just mark those as answered. If you have any burning questions, please go ahead to P3 to ask him the questions. Yeah. There's a question, is there any more upside for LHN, Sunny, and WeHer? Yeah, also for LHN, it's under coverage by Paul, but Paul is currently in other earnings briefing, so I can't really comment on LHN. But for Sunny Environmental is not under our coverage also, but I think I can give some insights. So recently their share price went up quite a lot, since it almost doubled. I think it doubled since the announcement that they scored more contract wins. And as to your questions whether there's any more upside, I think the potential catalyst will be them winning more contracts from PUB itself, because they have a very long track record, I think more than 20 years of relationship with PUB. So I do think that they can continue to score contracts with PUB. However, I do think that their valuations are a bit overstretched now, because based on PE itself, it is around 20 times PE for Sunny Environmental. And if you look at an average construction company's PE, it will be around 10 to 12 now. Yeah, so I do think that their valuations are a bit overstretched, but there is potential for some catalyst of them scoring contracts going forward. Yeah, regarding WeHer is under our coverage. I personally do think that there's still more upsides because if you look at WeHer's NAV book value per share, it is 0.71. And currently WeHer is trading at about 0.68. So it hasn't reached their NAV per share yet. And I do think that if you look at a close comparable, which is Centurion is currently trading at about a 20 to 30% premium to their NAV per share itself. I know it's not a very good one-to-one comparison. I mean apple-to-apple comparison because Centurion recently announced their REIT spin-off, so they are able to unlock more value from their properties itself. And for WeHer itself, one of their property, the worker accommodations, their lease is actually coming to an end in November next year itself. Yeah, so this is what investors are looking out for in terms of the possible risk ahead. But I do think that there is more upside for WeHer in terms of valuations as well as in terms of them continuously owning the Australia property itself, and they do have intentions to sell the property itself. So I do think that there's further upsides ahead for WeHer. Yeah. Yeah, for the LHN question, I think you can direct it to Paul in the P3 community. Thanks. It's a question, comment on micro mechanic and venture. Yeah, venture is also under Paul. Yeah, so I think you can direct that question to P3 community. But for micro mechanic, we don't cover micro mechanic, but I can try to comment on it. So they manufacture parts used in the semiconductor, mainly the equipment makers as well as the foundry players. Yeah, so as TSMC announced, they face a lot of demand in terms of AI chips for equipment makers. So I mean for foundry players. So right now, foundry player is experiencing an outboom, and also for equipment makers as well. We do believe that micro mechanic will be able to benefit from this industry trend, even though they did not disclose who their clients are. Yeah, but equipment players are currently facing an increasing revenue year on year. Yeah, so we do think that it's positive for micro mechanic as well. Yeah. There's a question: is there concentration risk for TSMC being highly dependent on key customers like Nvidia and Apple, who are highly susceptible to geopolitical tariff policies volatilities and CapEx spending based on AI exuberance? Is the valuations overstretched? Okay, I think I answered the first part of your questions first, whether there are is there concentration risk. If you I personally don't think so, because if you look at TSMC as a foundry player itself, they dominate the foundry segment globally. Because if you look at their closest competitors, Samsung and Intel, they are not doing well in terms of their foundry revenue. Only TSMC is experiencing explosive growth, and demand for advanced chip is also very high for foundry itself. Yeah, so I mean Samsung and Intel is still experiencing growth, but it's just not at the rate that TSMC is experiencing. So if you look at customers like Nvidia, Apple, and they have also more customers, for example, AMD, for example, Qualcomm. I mean, a lot of them will just go to TSMC as a foundry maker. So to manufacture their chips. So I don't think that the concentration risk is very high because TSMC is far ahead of their competitors. And whether the valuations is overstretched for your second part of your question, I based on the numbers I see, I don't think so, because TSMC's 1 year forward PE is about 20. But if you look at the average of all semiconductor companies across the different sectors, the 1 year forward PE is about 25. Yeah, so there is still a bit of upside in terms of comparing TSMC to its peers. Yeah, so I don't think the valuations are overstretched. Yeah, I think that's all from me for now. Yeah, thanks. Oh yeah, sorry. There's a question. What is the P3 community and how can I access it, right? Yeah. So you just have to use your phone and scan this QR code, which is being shown on the screen right now. Yeah. So that will lead you to the P3 app, and you just have to join the community and just type your questions into the equity research group, and we will take the questions from there. Yeah. Thanks.
Yeah, okay, let me try to answer some. What are drivers for entity DC REIT price tanking and now minus 6% versus IPO when the rest of the DC REITs rising? Yeah, so entity DC REIT, their portfolio is very heavy US, so that's more similar to Digital Core. So it's more of a comparison to Digital Core as compared to Keppel DC, where Keppel DC, like 60-70% of the AUM is in Singapore. So that's different. Like we saw, Singapore is the location where they can get like 50% rental reversions for their major contract renewals at the co-location assets. Yeah, but I did a presentation on DC REIT last 2 weeks back. So there are some headwinds for entity. So one of it is that their management fee will be paid fully in units. So over time, that will kind of dilute the share base. So in the immediate term, the yield will be higher. So like they mentioned, the 7.5% initial yield, but over time that will the DPU will decline because of that. That's one factor. They've also not set aside any capex reserve. Like for Keppel DC REIT, for instance, the policy is usually set around 7-8% of their DI, distributable income, as capex reserve. So that leaves about 92-93% of their payout ratio. So entity for the 7.5% yield that they mentioned, basically they've not set aside that, so that's 100% distributable income. And there was another question also that asking whether bearish outlook on Tesla, how will that mean further downside from entity REIT? Yeah, so that is also part of our view, where any headwinds, like, I mean, even though Tesla's lease is at 8 years and long-term lease for that, but definitely because Tesla, they account for like 30% of the tenants. So Tesla really is a major tenant for DC REIT. So believe any bearish outlook or any headwinds, like anything that's happening with Elon Musk or Trump, all these might have some headwinds for entity DC REIT as well, or rather at least it will impact some sentiment. So those are some of the reasons why we think entity DC REIT, the share price over 2 weeks is quite lackluster. Even though the first day there was a little bit of it was up a little bit, 2%, but then again it closed at $1 at IPO price. Yep. Yeah, so the GE question, yeah, unfortunately, not sure whether Glenn will be able to come back in, so I'll just leave it there first for now. Yeah, another question on Alan Wong CEO. Yeah, that one also leave it in first. Hi, between the Ascendas and Maple Street Industrial, which do you prefer based on current price? How is Bispa doing now? Yeah, so we don't cover both, so I can't really compare. Yeah, but for now, from my perspective, yeah, I think the US data center space, there is still demand, but the rents are not rising that high as well. And like for Maple Street Industrial, there is some indication that some of the leases from the US NA data centers, North American data centers, will not renew the lease. So that is a little bit a little bit of pressure there as well. And for business parks, in Singapore, business parks also very flat, like the island-wide vacancy for Singapore business parks over 20%. So business parks, the rents also are not increasing that much. The focus is really on the high quality business parks or very well located one like near MRT. So those can still perform quite well, possibly flattish rental reversions. But other than that, yeah, I think the business park rent reversion might not be so great. Yeah, and in the earlier slide, so I showed that the industrial rents are really stabilizing. So all that will affect um, business parks as well as other industrial properties. And yeah, what is a preview? Yeah, so for Mapletree Industrial, we're expecting kind of flattish performance year on year, or maybe just slightly up um, for DPU, and possibly they might get some interest savings. Yeah, similar to Mapletree Long. So yeah, the low, slightly lower uh, than expected interest rates from, especially from the fact that the 3 month SORA has really dropped so much. Yeah, what is your fundamental view of FCT given that RTS ready next year? Is F&B segment doing well? CNA says more F&B closing. Yeah, so the F&B segment is really the segment that's doing the best. And even if F&B segments are closing, there are ready F&B tenants or new F&B tenants or concepts that are ready to come in anytime, especially those like from overseas, like more Chinese F&B concepts and such. Your hotpot concepts are still very popular. Yeah, so the F&B segment is still one of the standout performers for retail. Yeah, like especially in your luxury malls. Yeah, the F&B side, that performance is doing way better than the fashion, for instance. Yeah, so some of the landlords are planning to in fact just change a little bit of trade mix to include more F&B into their more F&B tenants into their portfolio. Yeah, and on the fact that the RTS will be ready next year, yeah, I've spoken about this previously. I don't think that will have any serious negative impacts to the view on FCT suburban malls, given that the fact that well, like whoever has already been shopping in JB currently are already doing so, and I don't think just because of the fact that RT is ready, then more people will just go there and shop. So I mean, definitely there might be some, but I don't think that will be very significant. And the fact that when RTS is ready next year, it's also likely that a lot of more Malaysians will come to Singapore to shop, or I mean, not really to shop, but at least to come to Singapore to work. And when they come to Singapore to work, they definitely need to eat. And where would they eat? A lot of it is likely that they will go to suburban malls to eat. Yeah, so that will boost the F&B side of things from the suburban malls. Definitely, the RTS will increase the footfall, especially those located in the northern side, those malls at the North Point and Causeway Point and such. Yeah, so that is my take. Yeah, but fundamentally, suburban mall still remains the most resilient in our view. Yep, and in any economic downturn, like during COVID period, for instance, suburban malls were the most resilient. Yeah, is data center in US doing well? Mapletree Industrial doesn't seem to perform well in price. Is there something fundamentally not okay? Yeah, it's just the fact that they need to release some of the vacancies in the US data centers. Yeah, so that's one of the reasons. And there's also an indication that rather a lot of some of the tenants, if I can't remember off the top of my head what's the percentage, but I think 2% of the GRI has indicated they will not be renewing their data center lease. So yeah, that might be some little bit of headwinds there. We will get some updates later or during the earnings call that we will attend tomorrow. So yeah, we have some updates for that. Yeah, but then again, like I mentioned, Keppel DC is different because their assets 70% is in Singapore, and Singapore is really constrained by space, and the demand is still strong. So Singapore is the only location in geographically that we think that can really get this strong positive rent reversions. Other than that, we think the rent reversions likely flattish or just increase slightly for the other data centers, especially in the US. Yeah. Given IT tech has been changing and improving at lightning speed, how is Keppel DC being one that has been developed some years ago? How is it comparing and competing with those new launches? Yeah, so for Keppel DC, as most of it in Singapore, so that really drives the strength as there is a limited supply, and most of the data centers are also AI ready. Some of their data centers perhaps was refurbished between 2014 to or 2020, so might be a little bit dated, but they are looking to refurbish some of those. Like one example is SGP1, where they're looking perhaps to refurbish. There's some plans ongoing there, like doing a power study and such. So yeah, there are plans to refurbish some of the older data centers. Yeah, but generally, as they're strongly focused in Singapore, the demand is still very strong, and that's mainly because of the fact that the demand supply dynamics is definitely in Keppel DC's favor. Yeah, no, there's no other way that you can get like 50% positive rent reversion at renewal. Like every, every time you renew your co-location contract, like 2 3 years, the rent increase by 50%. Yeah, it can't. There's no other reason why it can happen unless the demand supply conditions are really in their favor, like limited supply. So that is still a plus for them. Yeah, but generally their DC assets are still AI ready, and they do have some new assets also, like SGP 8 and 7, the newly acquired. Those are new assets. Yeah, so they do have a mix of new assets and those a little bit that might need some refurbishment. Quantum data centers rental arrears have been ongoing for the past couple of years. How big a hole will this impact Keppel DC earnings financial position? Why are you giving higher TP with this issue pending? Yeah, so the quantum data center rental arrears has been like ongoing for almost 2 years already, yeah, right? And previously it accounted for almost 10% of their top line, but now with the acquisition of SGP 7 and 8 and some the Tokyo data center as well, this impact has fallen to like 5% or even lower. So the impact is not as much as previously, like as a percentage of portfolio wise. So right now they owe about 40%. Or what 40%? Sorry, 40 million to Keppel DC that they're still in arrears. Yeah, why am I giving a higher target price with this issue pending? Yeah, that's mainly because I readjusted some of the numbers. Previously it was 2.25 and I counted for about 30-40% positive rent reversion for some of the leases that were due for renewal. But this time in the first half the SGP4's renewal was upwards of 35%. So that really was an upside surprise for me. So I just adjusted some of my rental assumptions in my model, and as a result, DPU was up 2% for this year and up 1% in FY26 with my forecast. So that was some of the reasons why, based on the DDM, when we discount it back, the target price it rose. Yeah, so that is the issue. And the higher TP was $2.33, so it's not a very significant increase from my previous $2.25. Yeah, but definitely if they can receive payment from the quantum data centers, it will be a huge upside for them, like 40 million. But generally for China, the operating conditions, they are still facing some issues, especially the availability of high quality chips. So yeah, that is the big issue, like with the tariffs and such. What are your top 3 REITs now given the current price? Yeah, I don't really have the updated price with me, but generally our top 3 picks we like Stonewax still like the most. I think we said that for the longest time. The price performance has also been performing very well, especially now that they are entering the DC space from the sponsor and a lot of pipeline as well. Yeah, so that is one of our topics. Yeah, and other potential topics like we like FCT for our stability. So that's also another plus. Yeah, and we like those high yielding assets, like Elite also paying 9% yield. We like First REIT also because of the fact that they are paying high yield and there is potential for some asset monetization there, like when they sell their Indonesia properties. So these are some of our topics as well. Yeah. Yeah, what's the NAV for AIM CPET REIT? Yeah, I don't have the number off the top of my head. Yeah, I'll go and search it up and I'll type it in after that. Any updates on Manulife REIT? US office doing okay. Is Manulife out of the woods? Yeah, so for Manulife US REIT, they are still not out of the woods. They still need to sell. I think if I'm not wrong, they are still slightly short of the divestment target, 328 or 328 million. So they are short by about 100 million, if I remember correctly. Yeah, don't quote me on the number. I might have slipped my mind what the exact number, the figure was, but they do not have any recent updates. And yeah, they pushed back the deadline to end of the year. So yeah, but the fact that Manulife US REIT, they are located in geographies in the US where the performance is not doing too great. The occupancy is also not too great compared to the other two US REITs. Like Prime US REIT is also performing better. Prime, they recently managed to secure a huge lease at Washington, at waterfront at Washingtonian. So that is at a geography in Washington where basically the leasing demand and office space is the tenant demand is not very strong, but they still managed to secure a huge lease there. So that's a plus. Yeah, we don't see much update or leasing progress from Manulife's perspective. But we have to take a look at these upcoming results to see how things are for them. But generally, it is possible that in some of the recovery in US office is very split between different geographies or rather different locations in the US specifically. So yeah, we have to take a look at the assets as a location. Manulife's location it's not as good as Prime's and Keppel Pacific Oaks location as well. So these are some of the issues there. Yeah, but like for Prime, for instance, we are seeing some positive shoots, and we think the US office might be bottoming soon. Yeah, but for Manulife, definitely they are not out of the woods yet. As long as their gearing is not under 50% and they have not hit the divestment target, definitely they are not out of the woods. Yeah, what do you expect on first half results of MIT? Yeah, I already answered that. Kind of flattish TPU, some interest savings. Yeah, but for MIT, basically we are looking out to see the backfilling and of some of the vacant space. Yeah, upside potential for Prime US REIT, Keppel Pacific US REIT, MLT. Yeah, so for Core and MLT, we don't have coverage. We also Zain is also not in to give you any TA for upside potential. But for Prime US REIT, our target price is 20 cents. Let me check. The current price is 19 cents. Yes, the share price has recovered quite significantly over the past couple of months, or rather, the past month is up 16%. Yeah, so we might adjust our numbers based on the first half earnings, but things are looking good with the big renewal that I mentioned previously. Their price MLT, their price still dragged down by China issue, or are there other issues as well? Yeah, so for MLT, definitely China is still one of the issues for that. Another issue is that we see some of the other countries, like in Singapore, for instance, the rental reversions have really moderated from like the double digit, like teens level to now mid-single digit level. So this is all within our expectations and in line with the market as well. So these are not say headwinds, but it's just a slowing down in the very high rent reversion momentum from MLT's Singapore assets as well. Yeah, but for the China issue, it is recovering. There are signs of it bottoming as a lot of their leases in China have already been marked to market. So going forward, perhaps by the end of this financial year, or rather by the end of this calendar year, we might see some uh, the Chinese portfolio rental reversals might have already flattened. So yeah, it is likely that starting next year we could see some flattish reversions already instead of negative reversions for China continuing. So for MLT, yeah, might be possible that they have already bottomed operations wise. Yeah, Mars already answered. Yeah, is your in your Keppel DC presentation saw gearing is increasing from their financial standing? Any chance of cash going down to? Yeah, so if referring to EFR, yeah, it's unlikely as they low equity, but cash flow from operational standpoint, yeah, it's also not no cash call like significant that I'm aware of. Yeah, yeah, basically their gearing is likely to increase to 35. I mean, it will increase 35 once they draw down the debt to fund the land lease extension for the SGP 7 and 8. Yeah, so that leaves them still about some headroom, like 35%. They still have some headroom for more acquisitions. Yeah, like I mentioned in the earlier slide as well. Yeah, what's the view target price? Yeah, so for iFast, yeah, so iFast is Glenn follows it. Yeah, it doesn't cover, so but he's at a briefing now, so I don't think he'll be back in time. So you can pose this question in T3 or next week when Glenn's back, he'll have to answer that. Yeah, iFast refers medical. Yeah, that's for Paul and Glenn. Yeah, what is Stoneworks NAV? Yeah, Stoneworks NAV, I can't really remember, but off the top of my head, if I'm not right, I think it's about $2. Yeah, yeah, need to double check on that. Oh, yeah, there are my comments on Singpost. Yeah, I don't cover Singpost. I don't really follow, so I think that was more to Paul. Yeah, but unfortunately, it's not in. Yeah, so same thing. Anything, please post on P3. Uh, Let me see. Yeah, US. Yeah, CSE Global also. I think that's Paul. Yeah, unfortunately, no one can help to cover that. Any questions? If you want to type the question for CSE Global, yeah, please feel free to type in P3 as well. Um, yeah, here a view on Phillip's property outlook. Yeah, so for Phillip's property, I believe the new launch. Let me take a look. Yeah, yeah. Hand over to my colleagues first. Let me take a quick breather. Thanks.
Yeah. Hi. think there's a question. Appreciate to share your views and comments on high book value per share while earnings per share is not improving. Is such situation of holding unproductive assets a negative if the situation persists? Yeah, so I think it depends on the company whether they intend to sell their assets and monetize it. So it's not just in terms of earnings per share. Yeah, earnings per share is one metric whereby we can look in tandem with book value per share to see if it's worth it for the high book value per share. But I think it's also about monetizing the assets. So for example, if a company have a high book value per share, if they are able to sell some assets and give out those gains in terms of like special dividends to reward shareholders, then in that situation, it is also positive for shareholders to hold the share itself. Yeah. So for example, we do think that WeHer is undervalued in terms of book value because we do think that they will still have intention to sell their remaining stake in the Australia PBSA assets. Because, for example, they still hold a 13% stake in the assets which they previously sold already, which one round of special dividends was already given out to shareholders. Yeah. So for that particular group of assets itself, they still hold a 13% stake, which we feel that they will still continue to monetize that. Yeah. Hopefully that answers your question. I think that's all that I can answer for now. Yeah, for Wilma, we also don't cover. So think I think you can post your question on P3 community chat, and I think Paul may be able to take it from there. Yeah. Okay, thanks.
Yeah, there are some questions on like the US side. Yeah, does the US team have any comments for those like do you see any weakness in US stocks rally momentum or yeah, in the meantime, let me try to answer some. Yeah, will tariff benefit SG in terms of industrial property, business parks or logistics parks? Yeah, so from what we're aware so far from the REITs, we see the US exposure is not very high. Like most REITs, their US exposure or they do any business with US is less than 5%. So they're not much impact. But from a relative perspective also, like earlier you mentioned, Singapore's 10% compared to the other Asian 19 to 30 plus. Yeah, so definitely Singapore does benefit from that. Yeah, but generally Singapore REITs does not have much exposure to the US. Yeah, IFAS and Raffles Medical, yeah, unfortunately won't be able to answer that. Outlook for all three banks also, yeah, TA also, yeah, unfortunately unable to. What's the outlook for digital core REIT? As you mentioned, data center in US is not doing well. Yeah, so digital core REIT, the big issue now is that Lincoln Hall, the data center, the tenant will be vacating soon, or rather vacated already, and will undergo some AEI, so there'll be some downtime there. So as a result, DPU is expected to be hit a little bit. Yeah, so that is the issue for digital core REIT. Yeah, that is yeah, but generally other than that, like the Northern Virginia asset, we saw some very strong different reversions, and some strong demand from LA also. The occupancy improved, yeah, 98% now, and yeah, but generally for the Linton Hall, we're expecting about a 15-month downtime. So yeah, that will the DP will be hit from that. Yeah, the cost of that also improved. Yeah. Yeah, for Stonex, should buy euro rather than SGD based on liquidity volume. Yeah, you should buy euro because for the euro counter is also more trading volume and liquidity. Yeah, so I believe the SGD counter there's not much liquidity there. Yeah. Yeah, but definitely if we buy the euro counter, it will be impacted by FX. But as the operations are also in euro or in Europe and they receive most of the rent in euro as well. So yeah, we think you should get the euro counter. After we buy the SGD stock, it will also be converted from euro. So yeah, similar. Yeah, and since euro is the one that's traded the most, as most volume, yeah, you should trade in euro. Yeah, for fresh property, we're expecting some of the launches like Robertson Opus to perform quite well. And yeah, we're also performing, we're expecting the REITs under the Phrase parent to perform well also. And yeah. Yeah, yeah, there are some questions on the NAV. Yeah, let me go search that up and I will type it in the chat. Yeah, in the meantime, I don't think there are any questions. Are there other questions that we can answer? Yeah, I think there's a new question on AEM or Intel. Perhaps Iqbal could answer that after that, or the US team if you have any comments for some of the US questions also. That would be helpful. Yeah, other than that, we can close the webinar after this. Thanks.
Yeah, thanks for the question on AEM. Yeah, I think for Intel wise, their results is still not doing well. Their in terms of their segments, CPU segments they are still I think it's still on a very lackluster kind of results, and their foundry segment is also only up, I think 3%. It's almost flat. Yeah, even though they say it's better than expected because of customer demand pull-ins. Yeah, so in terms of their outlook is also not is I think it's only like a 2% kind of growth. So Intel, my view is that Intel still needs time for all this, still needs like at least 2 or 3 quarters before the operation restructuring can yield good results. Because as of this point, they said that only the employee cutoff has been done. Yeah, so that is the only progress as of now. And I think they also sell some assets which I mean those loss-making assets which they are able to yield some returns. Yeah. But whether or not going forward they are able to face their competitors in terms of foundry. For example, they have to compete with TSMC, and also their CPU segment, they have to compete with AMD. Whether or not they can kind of match their competitors, that is another story. We will still need many more quarters to go. Yeah. So for now, our view on AEM is still not very positive. Yeah. What is Intel's contribution to AEM revenue? Have AEM found any new customers? I think my impression is that it's more than half of AEM's revenue. Yeah, even though it is not being disclosed, and yeah, I think it's still sensitive data. Yeah, so we are not very sure. So whether AEM found any new customers, yes, they have been guiding that their revenue for this year for the other customers will be able to go up to 100 million. So this will make up some losses from Intel. Yeah. But it's not super material that it will make up the Intel's loss lah. Yeah, Intel's loss still outweighs that kind of contribution from new customers. Yeah. What is our view on Aztec Global and its fair value and target price? Yeah, so we don't cover Aztec Global. So we don't have a fair value and target price, but I think right now Aztec, their most recent earnings, their net profit is still down about 50+%. They're still not doing well because they are unable to secure orders. Yeah, so I think until we get a signal that they are able to achieve kind of secure order book and achieve an increase in orders, then that is the signal for growth in terms of Aztec. Yeah. I think there's more questions flowing in. What are the 3 top picks for semiconductors? We cover AMD and Nvidia, and I do think that that's the top pick for me because okay, firstly, for semiconductor, if you want to invest in the semiconductor space, it's better to invest directly in US. So if you invest directly in US, that will be either the advanced chip companies or the foundries or the equipment makers. So I do think that right now Nvidia and AMD is still my top pick because they have a very strong moat. Nvidia has a very strong moat in terms of GPU. AMD is like a little brother to Nvidia, and there is still a very strong demand for GPU because GPU is needed to run the AI workloads in data centers. Yeah, so our visibility for AI GPU demand is still strong going forward this year. Yeah, so we do think that I'm still very positive on these 2 companies. Yeah. Okay. I think I can hand over to my colleagues if they have any other questions. Otherwise, I will end it off soon. Yeah.
Yeah, what's the NAV for AIMS Impact REIT? Yeah, AIMS Impact REIT, the NAV is $1.23 as of end 2024. Yeah, so it's very primarily in Singapore, so over 70% exposure in Singapore, and the rest 40% that's in 30% or 20+% that's in Australia. Yeah, target price of first result, yeah, we don't cover, so we don't have a target price. Yeah, fair value for FCT, CICT. Yeah, CICT we also don't cover. FCT, we have a target price of $2.44. What is C2? C2 PU Parkway Life REIT, yeah, we also don't cover. We don't have a target price for that. Yeah, FLCT. Last comment. Yeah, so for FLCT, they managed to divest the more of the office assets in Melbourne. So there is a 357 Collins Street. So that is a huge plus for us, because considering that that property has a high vacancy rate, and its exit yield right now is 4%. So we think that is a positive in a very challenging market rate, and it's also divested at a premium to latest valuation 0.6%. So that is a huge plus for us also. Yeah, so that's the latest update. Yeah, but generally, we need to see the backfilling of the Google space at the ATP. Yeah, so that is one of the issues there. Yeah, I think that's all the questions that we can answer. Yeah, unfortunately today, so many of us are not in because of it's usually big period, a lot of other briefings to attend to. And also unfortunately Zane is not in to answer TA. Yeah, but other than that, if you have any burning questions, yeah, please feel free to just type it in the B3 and we'll try to get to those questions. And yeah, if not, thanks for joining us again. I hope to see you for some corporate insights webinars. And yeah, that brings us to the end of today's webinar. Yeah. That's all. Thanks again. Bye bye.